Hello and welcome to The Trade. We are coming at you from our studios here in Barangaroo and we are ready to talk everything trading. I'm Cara Ordway. Alright, today I want to jump straight into it. It's earnings season here in Australia. We're almost finished in the US, and with all eyes on equity markets, what do you need to consider if you're trading on stocks on the back of breaking news? Well, trading equities can be very different to the buy and hold long-term investing. And as we always say, it's all about timing when it comes to your entry and exit points on the trade. So how do you make sure that you're not caught off guard? For his take on what you need to consider when picking the trade and his outlook for the ASX, we are now joined by Capolingua from Thinkmarkets. He's live in Perth. Carl, welcome to the show this morning. All right, let's talk trading those equity markets. You've decided to buy. It can be crazy out there. What cautionary tales have you got for us when it comes to purchasing those stocks?
Yeah, good afternoon, Cara. Thanks for having me on. Look, it's a lesson I think all investors have to learn. If you're new to the market, this is absolutely important, crucial information you need to take in today. And even if you've been around for a while, there's always little tips and tricks that we need to be cognizant of. So we're talking about where the rubber meets the road. We've decided we're going to buy. It might have been Wall Street Bets or something like that, the chat room, a favourite chat room that's inspired us to do so. We jump into the market. It's crazy. There's a frenzy. It's the best thing ever, this stock. We click buy. We think we're going to get, for example, say 30 cents, and we end up getting 40 cents. The contract note comes back and we're scratching our heads and we can't figure out why that's happened. So it's quite common on most discount broking platforms these days, and look, more traditional ones not the case, but definitely the newer ones have come into the market to only have these market orders. And there's a few type of orders you could use to enter your trade. So market orders is one of them. Limit order is probably the other big one, but the market order is the risky one. That's the one we need to be totally across, understand how it works and the risks and pitfalls of that one.
Yeah, I know you brought a bit of a picture with you when it comes to Afterpay and those market orders. Obviously, it's all about liquidity, isn't it? What's actually there in the market for you to take off the table when it comes to those purchases or exits. Obviously, you don't want to get stuck in that trade. So what are you looking for when it comes to timing or in terms of those order books that you're looking at?
Yeah, look, I mean, personally, I'm a bit more conservative when it comes to trading those frenzied stocks. However, I understand that many of your viewers will be in that boat. So inevitably, you've got your broking platform. You click on it, whether it's on your desktop or an app, as they tend to be these days. I think we've got an image coming up, which is a picture of our own Think Trader app, but it's probably very similar to the one that you're using. And you've got a few options there you can select. So obviously sell or buy. We're looking to buy this one. We're looking at Afterpay here, and I just literally picked a stock that we're all familiar with. And then we've got our order type. This is where we need to be very careful. So the one I've selected there is called market to limit. And that's because we don't actually have a market order on our platform. So we've got this concept of a market to limit, which replaces the market order where you will type in the number of shares you want. For example, here 100 shares. And it will put an order in at the best market price, which in this case is 158.02, and it will sit there with the market order to buy your shares. And the reason why we want to avoid using those market orders is a typical market order won't stop at any particular price. It'll just keep, like Pac-Man, chewing up any stock in its way until it fills your order. So in this case, if you wanted to buy the 100 shares, you'd end up buying the 31 at 02, you'd take the 27 at 03, and you just keep going until you get 100 shares. And you'd end up paying an average price of maybe 158.05 or 04 as your price. So don't forget, this is actually really important. Investors need to write this down. For every 100 shares you trade in, Cara, for every 1 cent the share price moves, it's worth $1 to your P&L. So in this case, if we were buying 100 shares and we ended up paying 2 or 3 cents more on the stock than we thought we were going to pay, we've actually paid an extra $2 or $3 to the market, not to our broker. It's gone in the spread. And the spread is the difference between obviously your best buyers and best sellers. So that is lost into the market, and it's a cost, and like any cost, we want to minimise that as much as possible. So just be really careful with those market orders. As I said, we don't offer them. We think they're quite risky for clients. Many brokers only give you the ability to use market orders, and that frightens me a little bit. So definitely make sure your broker has the other option, which we might switch to now, which is the limit order. Now, the limit order gives you the ability to specify the price that you want to pay at. You'll never pay more than that price, and it gives you some certainty as to what you're going to pay. Now, the risk with a limit order, it's not all sunshine and roses. The risk is you might not get filled at the price. So if we're looking at the example on screen now, we can see that Afterpay is quite a wide spread on it at the moment. So 157.93 up to 158.02. We might decide, well, the last price is at 93 and we think we could get a little bit cheaper than 02. We might bid, say, 157.95. And again, don't forget, if you can save that 7 cents, that's worth $7 on this trade. The problem is if the stock doesn't trade down to our level and then starts to go up, we could be in trouble there because we might miss out on that trade. So you've got to balance things out. You've got to understand how urgent your order is. I like to trade in a way where my orders aren't urgent, where I've done the research first. I know what I think the value of the company is and know what I'm prepared to pay, and that's another strong recommendation for all viewers out there. Don't get caught in the hype, and then use the appropriate order to stay safe in the market and save yourself some money. If you can save $2 or $3 by using the right order on each trade, add that up over 10 or 20 trades over a month or over a year, it's going to add up to quite a big saving.
Yeah, as you said there, those limit orders are important when you're looking at a specific level for that entry or exit. All right, Carl, I know you brought a CPH chart with you when it comes to, as you said, a cautionary tale when trading. You mentioned there, the price could jump from 30 to 40 cents and you've just missed it. So you don't want to buy on that high. So what are we looking at when it comes to that chart, and where should traders be thinking of getting in when it comes to buying this stock?
Okay, absolutely. So this sort of harks back to our discussion last week. So let's start with where to get out first, and then we'll talk about the getting in. So the getting out part, we talked last week, we're watching for a big price action reversal, and that's that giant bar in the middle. You can't miss it. It's got the long line up the top. We call that a shadow in Japanese candlestick speak, and a very small body. So it indicates a stock that opened around 30 cents. It shot up a massive amount during the day. It had a high around sort of 46, 47, and then by the close, it ended up back around 30 cents. And wouldn't it be a shame in that frenzy if you thought you're buying at 30, you end up paying 40 because you used the wrong order. So it's that price reversal that tells us that the selling has come in. When you accompany that with the huge volume spike we can see in the blue bars, we talked about that last week, and then the big spike in the range. The combination of those factors tells us that there might be a bit of a changing in the guard here. The money that was in very early is probably selling to the money that's coming in late. So that's where I'd start to be very cautious. You can see the big black candle on the next one. And pretty much for me, the story is over, and we can see that CPH never got, or still hasn't got anywhere near those highs. So that one stands out very clearly for me as where to get out. Where to get in, again, we're looking more to the left of the chart. And we start to see, I guess, where the stock was very flat and the prevalence of those white candles, we call them. So they've got more of a white body to them and fewer of those lines. And then the volume starts to pick up. So volume is a little bit, I think with the volume in the market, like the volume on your stereo. When the volume on your stereo is very, very low, it's hard to hear. No, and somebody across the room, across the road isn't going to hear it. They're not going to know about it. When you start to turn the volume up on your stereo and in the market, that's telling you that people are becoming more interested, to the point where if the volume's through the roof, you're going to hear it across the road, as was the case in CPH. So we're looking at price, we're looking at volume, we're looking at volatility to tell us, give us those cues on to when to get in and when to get out. And look, I challenge viewers to go and have a look at some of the stocks they've been following, maybe some of the ones with the big moves, and I guarantee you're going to see those same price, volume and volatility signals on that chart.
All right, Carl, thanks so much. It's all about those limit trades, isn't it? It's all about the volatility and those volumes that you need to be made aware of as you're entering those trades. Thanks so much for joining us this afternoon.
Thanks, Carl. Always a pleasure. Catch you later.
All right, that does it for this edition of The Trade. Be sure to tune in tomorrow. We'll be back with all the action, and stick around, though Koshi is up next with CBA Chief Executive Matt Coman. Thanks for watching.